Power-nomics! Currency manipulation, or pegging, gets thrown around quite a fair bit, but without a proper understanding behind the mechanics of it all, it creates a very artificial, oversimplified, and worst of all, antagonistic view.
To view China and America as opposing sides in some kind of trade war is simply basic. It's basic, bro, economics. This channel's concepts are advanced, high-level, 4D powernomics. The Chinese need the US market for its exports. American government spending is also not going to be reined back. There's a wall to be built, freedoms to defend, and talks of universal basic income. The two countries are so far stuck up each other's arseholes that any sudden pullout will result in major prolapsed anuses everywhere. This uneasy and untrusting relationship needs to work and continue to work if both countries wish to avoid major economic calamities.
The price of the Chinese renminbi, like every other currency in the world, is determined by supply and demand on the open market. The Chinese government does not go around with thugs and goons and staunches every bank or money exchange into accepting its artificially low price. Neither do they play some kind of Jedi mind tricks with all the buyers and sellers in the market so that everyone is somehow fooled or manipulated into accepting this artificially low price. No, everything is done legally and transparently through open market transactions.
Here's what happens. Everyday nerds working behind computer screens at Chinese banking institutions buy and sell the renminbi on the open market to maintain the price level they've determined to be most beneficial for the growth and stability of the Chinese economy. To lower prices, they increase the supply of the renminbi by selling it, and inversely, to increase prices, they increase the demand by purchasing it on the open market. But more often than not, they aim at lowering its value for a competitive edge on their exports. China is not a rich country in natural resources, and manufacturing is really the only industry available in making that bank. As the US and other foreign countries purchase Chinese products, they are required to exchange their currencies for the renminbi, as Chinese businesses tend to only accept the renminbi for their Chinese products. This drives up the renminbi's demand and along with it, its price. In a perfectly competitive world, China would eventually lose its price advantage as its currency appreciates in value. But China doesn't want to lose its price advantage and counteracts this by dumping the renminbi for other currencies on the open market, ensuring its price as well as the subsequent price of Chinese goods remain low. This interventionist policy to manipulate the price of the renminbi on the open market is what the Trump administration is protesting and seeking to rectify. But there's nothing they can do about it. Everything is done legally and legitimately. They can't really interfere or stop the open market from taking transactions. It would be against the principle of the free market. You can't really hate a player for playing the game.
But things aren't all peaches and cream for the Chinese also. In continually shorting their currency for other currencies, the Chinese are left holding vast quantities of foreign reserves, so much that it's become too much to spend. And having liquid foreign cash sitting around growing mold just isn't very intelligent. So for the past 20 to 30 years, the Chinese have been buying government bonds of other countries, in particular the US. China now holds 1.12 trillion in US government bonds. This has helped the US government fund their growing spending deficit. Now we're at an interesting standoff. China can really hurt the US by dumping all its government bonds on the open market. This would increase the cost of borrowing and has potential to send stock markets crashing. But in doing so, China would only really hurt its largest export partner, as well as lose decades worth of accumulated wealth. Think about how many Chinese peasants it took, working in sweatshops, making about 800 US a month, to accumulate 1.12 trillion. That's a fucking fair whack. Furthermore, with the US government debt bloating out of control, especially after the multiple quantitative easings during the global financial crisis, serious concerns are being raised over the ability of the US government to service its debts. This has put downward pressure on the value of US government bonds. And in order to fight this or risk taking significant losses on their asset holdings, the Chinese have trapped themselves into buying more US government debt. In understanding that a major US economic collapse would also bring China to its knees, we see that China's US bond holdings close to tripled immediately after the 2008 financial crisis, only slightly dipping during Trump's election in 2016, then immediately ticking back up again. Even with the recent scares broadcasted by many media outlets, an 80 billion sell-off really shouldn't have us holding on to the edge of our seats. It's simply cheap posturing or internal adjustments calculated by Chinese bank nerds. I'm sure the US is not totally unaware of this as well, that China needs a strong, stable, and confident US economy for its own benefit. So don't believe in the mainstream media or the ocean of basic bro halfwits on YouTube. This channel is the only one with deep analysis on the metagame of global economics. If you found this video powerful and informative, smash a like or subscribe, or flicker some cash on my Patreon. It would really help motivate me to make more videos. There are definitely more powernomic topics I want to sink my teeth into.